China's financial distress is not surprising as the property sector's financial difficulties emerge. China's economy is faltering as a massive credit bubble that powered expansion for a decade bursts. Depositors and investors wonder when Beijing will step in after repeated asset class defaults and bankruptcies. Beijing's lengthy history of financial crisis intervention has protected China from calamity, but losing credibility has implications. Beijing will likely use the central bank's balance sheet to regulate local government finance vehicles' bond defaults. The credit cycle turns. China's 2022 economy was terrible. Speculation about the recovery's strength and leading industries began before the year. Lockdowns slowed the economy in Q2 to 0.4% actual GDP growth, almost 10% annualized. No official growth targets. Private companies delayed investment due to low credit demand. Early autumn lockdowns in Chengdu and nationwide testing before holiday travel hurt the economy. COVID-19 limitations, service industry employment and income uncertainty have impacted households the most, lowering spending. Henan bank demonstrations, mortgage boycotts, and developer defaults show financial stress. The storm centers on China's property industry, which accounts for 24% of GDP, 30 to 35% of employment, and 30 to 35% of the credit. In mid-August viral social media posts, local leaders advised subordinates to buy houses even if they owned many. Developers can't finish 2020 and 2021 dwellings since 2022 property sales income are down 31.4%. They await Beijing's funding. COVID-19 related restraints have accelerated and worsened a necessary economic shift. In 2022, the property sector was forecast to drag on growth, dwarfing any infrastructure investment upswing. China's underperformance, other than COVID-19, has been years in the making. The October 2018 CSIS report Credit and Credibility highlighted China's rapid credit expansion in driving growth over the previous decade and Beijing's financial crisis intervention in avoiding crises. Beijing began deleveraging in late 2016, admitting that loan growth averaging 18.1% from 2007 to 2016 was too fast and that financial system conditions were unsustainable and needed immediate correction. Since 2017, lowering the shadow banking sector has halved lending growth, cutting off numerous borrowers and financial institutions. Rhodium Group and CSIS's Grasping Shadows will evaluate China's deleveraging campaign's effects on its economy and finances in early 2023. Beijing delayed a credit growth slowdown to avoid defaults by borrowers who kept rolling over loans. Peer-to-peer lending, corporate bonds, local state-owned corporations, trust companies, smaller commercial banks, and property developers became hazardous in 2018. As late as 2017, China shifted from a position where most financial instruments were unfaultable to one where they are becoming increasingly common across a rising range of asset classes. With defaults rising, guarantees are losing credibility. Beijing's implicit asset guarantees would lose credibility, hurting the economy. Credit and Credibility argued that China's long financial stability was attributable to government protection of investors, banks, and enterprises from financial losses, not its high savings rate or internal debt. The 2015 bailout of the boom and bust equity market followed a decade of lesser interventions. Beijing didn't want to maintain subsidizing informal banking sector funding tactics that became systemic dangers from 2012 to 2016. Beijing removed these implicit assurances as shadow banking loan defaults increased. Investors will doubt other secure assets after losing money on a guaranteed investment. Beijing's bailouts have disappointed investors since the deleveraging effort began. Investors wonder if Beijing will interfere due to property sector defaults or economic and financial hardship. Trust products, wealth management products, structured deposits, state-owned firms, corporate bonds, banks, and individual mortgages can lose. Therefore, few asset classes have government support. Credit expansion and investment will halt as Beijing's government assurances lose trust. China's strong economic growth after the global financial crisis has changed, and lenders and borrowers are becoming risk-apprehensive. Property fallout will amplify financial distress. China's housing market slump shows risk aversion. China's massive credit expansion favored property. Rapid loan growth increased property prices, construction activity, land prices, local government revenues, economic development, additional credit expansion to the sector, and even higher property and land prices. The property bubble lasted 2 decades because local governments depended on the market and rising land prices. Lending circumstances fueled China's property market. Due to credit constraints, Chinese authorities will struggle to stabilize the property industry. Only the credit-dependent sector's high expansion from 2017 to 2020, when the shadow banking system contracted, is surprising. Starting in 2017, property developers employed pre-construction housing sales to replace shadow banking funding to boost growth. Fiscal and credit policy cannot fully offset developers' property sales collapse. Developers' annual residential housing sales revenues peaked at $2.7 trillion in June 2021 and have declined to $13.2 trillion, a loss of $4.8 trillion or 4.5% of GDP. Due to the recession, more homeowners threaten to halt mortgage payments, making pre-built homes less appealing. In credit and credibility, the Chinese system is most vulnerable to reforms like Beijing's property sector crackdown, not exogenous shocks like COVID-19. Beijing technocrats fear the property bubble. Thus, Beijing's financial tolerance for market support is unknown. Uncertainty lets sector losses spread financial contagion. Local government financing vehicle bond defaults are next. Local government budgets burden the property sector hardest. Land sales to struggling developers have plummeted 48% by area and 32% by revenue this year, impacting neighborhoods, according to Ministry of Finance estimates. Local government finance vehicles, LGFVs, were shadow banking system borrowers. Hence the deleveraging program hurt informal funding in many places. Northeastern and Western Chinese credit contracted sharply. Investors analyze credit risks based on municipalities' fiscal concerns after local government state-owned enterprises defaulted on corporate bonds. The last Rubicon is onshore LGFV bond default. Because China's bond market contains few, safe assets with good returns, investors consider them assured. Local government financial hardship and declining land sales revenues will cause LGFV bond defaults. After the 20th Party Congress this autumn, freshly nominated local officials may wait 2 months to escape their predecessors' debt. LGFV bonds have shrunk from 5.5 years in 2016 to 3.3 years in 2022, making refinancing difficult for these companies. If LGFVs can't refinance, Beijing's fiscal policy instruments will collapse. Local government debt bailouts like LGFV are coming. Where are the technocrats? Slowing Chinese credit growth has predictable implications. Beijing must decrease interest rates to manage debt. Expanding the central bank balance sheet is the most obvious way to absorb rising defaults, which will likely cause capital outflows and further depreciation of China's currency. Technocrats perform better during credit expansions than during credit bubbles. Investors are puzzled by China's economic technocrats' reluctance to address economic and financial instability. Beijing must set a border to protect government guarantees on major state-owned firms and state banks. Until Beijing chooses, defaults will spread to other asset sectors, undermining credibility. Beijing would have to rescue, fiscal, or monetize local government debt if LGFV bonds failed widely. If China boosts the central bank balance sheet to control domestic financial stress, it will look like crisis management, not monetary or counter-cyclical policy. China's central bank has justified its refusal to utilize unconventional monetary policy to address COVID-19's economic effects. But China's towns are in dire need of bailouts. A gigantic credit bubble will cause China's slow financial downfall. The deleveraging effort may have shown China's system's suppleness and Beijing technocrats' systemic risk management. Rapid shadow banking system expansion would have worsened and created a crisis earlier. Deleveraging substituted one financial risk with another, and slowing credit growth and Beijing's credibility had widespread and predictable impacts. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, hit that subscribe button before you go. Thanks for watching.